Investing is one of the best methods to grow your money over time and reach your financial goals, but you shouldn't go into it expecting to get rich quick. Long-term wealth creation has proven to be the most reliable method in history. The stock market might fluctuate in unexpected ways, but the best approach to dealing with volatility is to stay patient. A patient investing strategy promotes the long-term acquisition and holding of high-quality enterprises. Long-term investors can achieve big monetary profits in this manner without spending excessive amounts of time sweating over their investments. Hello everyone, and welcome to a brand new video on the channel. Today we are going to talk about the top 10 investment strategies for long-term growth. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Number 10. Review your strategy. Even if you're happy with your overall investing strategy, you should assess it on a regular basis and, if necessary, make changes. That being said, as tempting as it may be, don't constantly monitor your finances in order to prevent behaving rashly. If you're committed to the long term, short-term swings shouldn't matter. Ideally, an annual assessment should be conducted. When reviewing your portfolio, make sure your allocations are still on track. In rising markets, for example, certain equities may outgrow their targeted amount in your portfolio and need to be reduced. If you don't update your holdings, you can end up taking on more or less risk with your money than you intended, which is risky in and of itself. Rebalancing is an essential component of any investment strategy. You should also ensure that your holdings are performing within expected ranges and that any funds you own are adhering to their original investing strategy. Number 9. Impact of fees. One thing investors may do to tip the scales in their favor is to pay as little as possible for each trade and keep other administration fees to a minimal. Unfortunately, in the investment world, balancing fees and charges can be difficult because they differ from one supplier to the next. As a result, it's a good idea for beginners to have some sense of the type of investor they're going to be. Questions to consider include how much money you intend to invest, how frequently you intend to trade, and which markets will account for the majority of your purchases. Are you going to buy funds, stocks, or a combination of the two? The more sophisticated your arrangements, the more careful you must be about potential costs. Comparing rates from one supplier to another prior to signing up can result in savings of hundreds of pounds per year in administration fees alone. Number 8. Core and satellite investments. Whether you're new to investing or a seasoned investor, one alternative is to employ a core satellite investing method. This technique entails having a broad core of assets to serve as a foundation, along with more specialized, satellite investments appropriate to your investing goals. Overall, you must be satisfied with your asset mix. Extra exposure to shares is a possibility if you are okay with taking on additional financial risk and holding your portfolio for the long term. Property, through investment trusts, and commodities such as gold can provide investors with a significant aspect of diversity. Number 7. Don't overcomplicate. The world of money, and particularly the stock market, might appear difficult to a newbie. So difficult, in fact, that it discourages would-be investors from engaging in the first place, risking missing out on the long-term rewards of investment. If you have some strong investment building blocks in place to begin with, you should be able to get your investing journey off to a good start, keeping the preceding caveats in mind. If required, start with simple, wide, and low-cost products and work your way up. Investing in a low-cost index tracker or exchange-traded fund, ETF, is one way to keep things simple. These are passive investments that seek to imitate the performance of a market, such as the UK's FTSE 100 index of leading shares, by owning all or the majority of the firms that comprise the index. Asset funds provide a way to acquire exposure to a professionally managed, varied portfolio of assets, including equities and bonds, with a single transaction. Number 6. Expand your horizons. Listening to or watching how global stock markets act on any particular trading day will reveal that their movements are frequently correlated with one another. In other words, they prefer to move together up and down. However, returns from markets in different locales frequently change, with leaders and laggards shifting from month to month and even year to year. Ensuring that your portfolio is geographically diverse allows you to capitalize on as many opportunities as possible. Remember that no single country has all of the top companies, so spreading your money around the world helps to cover all of your bases. Number 5. Own a broad mix of assets. You don't have to be a financial specialist to grasp that the stock market can undergo significant ups and downs in relatively short periods of time. This summer, for example, the S&P 500 stock index in the United States sank by 20% since the beginning of 2022. However, it has begun to recoup those losses since then. According to experts, having the majority of your investment portfolio invested in the stock market makes sense as long as you have time on your side. When compared to other asset types such as cash or bonds, investing in stocks and shares has historically produced the strongest returns. It's important to remember, however, that stock and share investors can finish up with less than they started with, especially in short periods. Other assets, in addition to stocks and shares, can provide balance to your portfolio by performing differently and smoothing out some of the more dramatic market fluctuations. Number 4. Work out a style and choose your investment vehicle. It's important to decide whether to invest bulk sums or recurring, smaller amounts right away. A decent starting point is to drip feed money into a chosen investment in modest increments, either monthly or quarterly, regardless of the price at the moment. This method reduces risk by ensuring that you continue to invest through both market highs and lows when share values are lower. It also gives inexperienced investors time to comprehend the markets, allowing them to adjust to the ups and downs of investing and not panic if the market falls. Once you've determined your aim, investing horizon, risk tolerance, and what you want to invest in to meet these criteria, you'll need to figure out how to invest your money. DIV investors have numerous options available to them, including a simple investment account with one of the many online platforms that provide access to stocks and funds, and, if necessary, an additional option for self-invested pension planning. Number 3. Pick a strategy and stick to it. There's not much point in undertaking an investment journey if you don't know the reason why you're doing it. Research has shown that those investing with a life goal in mind and who track their path towards achieving that target end up with more successful outcomes. You'll need to decide how to invest your money once you've chosen your goal, investing horizon, risk tolerance, and what you want to invest in to achieve these criteria. DIV investors have a variety of options, including a simple investing account with one of the many online platforms that allow access to stocks and funds, as well as, if necessary, an additional option for self-invested pension planning. Number 2. Know your time horizon. Everyone has different financial goals, such as developing a savings account, paying for school or higher education, or budgeting for retirement. Having a time horizon at the start of your investment journey, that is, calculating roughly how long you have before you want to attain your goal, is critical to long-term investing. There is no definitive definition, but 5 years would be considered the bare minimum when developing a long-term investing strategy. Ideally, you would give yourself between 10 and 25 years. Time frames like these provide your portfolio with more opportunities to take on additional risk while presumably benefiting from the possible upsides of higher returns. Number 1. Set up a rainy day fund. There's little point in putting money into the stock market if you're struggling to pay your bills on a daily basis. The same caution applies if you have ongoing debts or no emergency reserves to deal with life's tiny emergencies, such as mending a broken boiler or having money set aside in case your automobile needs repairs. Before considering even the smallest amount of market exposure, try to get your daily finances in order. After that, you can concentrate on more risky investments, secure in the assurance that any day-to-day demands on your cash are met. Achieving this gives your invested capital the opportunity to grow over time, absorbing market ups and downs as they occur. That's a wrap on the video. I hope you liked it. If you did, let me know by giving it a thumbs up, and do not forget to subscribe. Thanks for watching. See you next time.